Today, I am going to tell you a true story. A story so shocking that many people find it hard to believe after hearing it. It leaves people surprised, disturbed, and deeply worried that such things could happen in the real world. This is a story where wealth, power, and exploitation were deeply connected. A story that challenges what many people believe about justice and influence. For an ordinary person, it may sound impossible, like something from a dark movie or hidden history. But this is not fiction. This is a bitter reality that the world has had to face.
Every single day, billions and sometimes trillions of dollars move across invisible digital screens in just seconds. Fortunes are made before lunch, and fortunes are lost before dinner. Ordinary people suddenly become financially free, while others walk away confused and disappointed. Behind this fast-moving world lies a powerful system that controls much of the global economy, the stock exchange. You hear about it in the news when markets crash. You see it mentioned when companies celebrate record profits. Politicians talk about it. Billionaires monitor it constantly. What exactly is it? Is it just a place where people gamble on prices going up and down? Or is it one of the smartest wealth-building tools ever created? And if it creates so many opportunities, why do some governments heavily regulate it, restrict it, or sometimes even shut it down during crises? Today, we are going to break it all down in simple, clear language so that anyone can understand it. At its core, a stock exchange is a marketplace. But instead of buying fruits, clothes, or cars, people buy and sell ownership in companies. When a company needs money to grow, expand, build factories, or launch new products, it does not always borrow from a bank. Instead, it divides itself into small pieces called shares and offers those shares to the public. When you buy a share, you are not just buying a number on a screen, you are buying a small piece of that company. If the company grows and becomes more profitable, the value of your share can increase. In some cases, the company even shares part of its profits with you through dividends. Stock exchanges like the New York Stock Exchange, NASDAQ, and Germany Stock Exchange operate as organized platforms where these buying and selling activities happen in a regulated and structured way. Prices move based on supply and demand. When more people want to buy a stock, the price rises. When more want to sell, the price falls. It sounds simple, but behind it is a powerful system influenced by company performance, global events, politics, technology, and even human emotions like fear and greed. Understanding how this system works is the first step toward using it wisely instead of being controlled by it. What is the stock exchange? The stock exchange is a structured financial marketplace where shares of publicly listed companies are bought and sold. But to truly understand it, think of it as a bridge between businesses and investors. Companies need capital to grow, to build factories, develop new products, hire employees, and expand internationally. Instead of relying only on bank loans, they divide their ownership into small units called shares and sell them to the public. When you purchase a share, you become a partial owner of that company. That ownership may be small, but it gives you a claim on part of the company's profits and assets. Stock exchanges, such as the New York Stock Exchange, NASDAQ, and Germany Stock Exchange, provide the organized platform where this buying and selling takes place. They ensure transparency, pricing mechanisms, and regulatory oversight. 8. Prices change every second based on supply and demand. When investors believe a company will grow, they buy shares, pushing prices up. When they fear losses, they sell, pushing prices down. The stock exchange is not just a trading floor. It reflects economic health, political stability, innovation, and investor psychology. It plays a critical role in wealth creation and economic development worldwide. How the stock market works: the stock market operates through a network of brokers, electronic systems, and regulatory bodies. When you decide to buy a stock, you place an order through a brokerage platform. That order enters the exchange system, where it is matched with a seller willing to sell at your price. This matching happens in milliseconds. Market prices are determined by the highest price buyers are willing to pay and the lowest price sellers are willing to accept. This constant negotiation creates price movement. Large institutions like mutual funds, hedge funds, and pension funds also participate, often moving markets with large trades. Stock prices are influenced by earnings reports, economic data, interest rates, political events, and global crises. There are two main market conditions: bull markets, where prices trend upward, and bear markets, where prices decline over time. Volatility is natural. Short-term fluctuations are common, but long-term trends often reflect business performance and economic growth. Regulations exist to prevent fraud, insider trading, and manipulation. Without regulation, trust would collapse. The market thrives on information, expectations, and confidence. Understanding how orders are executed, how liquidity works, and how investor sentiment drives prices helps investors make informed decisions instead of emotional ones. You earn money. Capital gains. One of the primary ways investors earn money in the stock market is through capital gains. This happens when you buy a stock at a lower price and later sell it at a higher price. For example, if you purchase shares of a company at $50 and sell them at $80, the $30 difference per share is your profit. Capital gains can be short-term or long-term. Short-term gains come from quick trades, while long-term gains result from holding investments for years. Historically, long-term investing has proven more stable and rewarding because companies tend to grow over time. However, capital gains are not guaranteed. Stock prices can fall due to poor earnings, competition, economic downturns, or global crises. Smart investors study company fundamentals such as revenue growth, profit margins, debt levels, and leadership quality before investing. They also understand that patience plays a powerful role. Instead of reacting to daily market noise, disciplined investors focus on long-term value. Capital gains reward those who can identify strong companies early and hold them through market cycles. How you earn money? Dividends. Dividends are another powerful way to earn from the stock market. Some companies share a portion of their profits with shareholders in the form of regular payments. These payments are called dividends and are usually distributed quarterly. Dividend-paying companies are often well-established, financially stable businesses. Investors who focus on dividends aim to build a steady income stream rather than relying solely on price appreciation. Over time, reinvesting dividends can significantly increase wealth through compounding. Compounding means you earn returns not only on your initial investment, but also on the returns that investment generates. For example, if dividends are reinvested to purchase more shares, those additional shares also generate dividends in the future. This snowball effect can be powerful over decades. Dividend investing is often considered less risky than aggressive growth investing, but it still requires research. Companies can reduce or eliminate dividends during financial difficulties. Therefore, analyzing cash flow stability and payout ratios is essential for long-term success. Long-term investing versus short-term trading. Investors typically choose between long-term investing and short-term trading. Long-term investing involves buying quality stocks and holding them for years, sometimes decades. This strategy relies on business growth, economic expansion, and compounding returns. It requires patience and emotional discipline. Short-term trading, on the other hand, focuses on price movements over days, weeks, or months. Traders attempt to profit from volatility. While trading can generate quick profits, it carries higher risk and requires constant monitoring, technical analysis skills, and emotional control. Many beginners are attracted to trading because of fast money stories, but statistics show that consistent long-term investing often outperforms frequent trading. The transaction costs, taxes, and emotional mistakes reduce trader profits over time. The key is understanding your personality, risk tolerance, and financial goals before choosing a strategy. Top 10 smart ideas to benefit from the stock market. First, start with education before investing money. Second, begin with small amounts and increase gradually. Third, diversify across industries to reduce risk. Fourth, invest consistently using dollar-cost averaging. Fifth, focus on strong fundamentals. Sixth, avoid following market hype blindly. Seventh, control emotions during crashes. Eighth, maintain a long-term perspective. Ninth, review your portfolio periodically. 10th, never invest money you cannot afford to lose. These principles help protect capital while allowing steady growth. The market rewards discipline more than excitement. Risks and market crashes. The stock market is not risk-free. Prices can fall sharply during economic recessions, wars, pandemics, or financial crises. Market crashes often happen when fear spreads rapidly among investors. Emotional reactions amplify price declines. Risk also comes from poor company performance, fraud, or mismanagement. Inflation and rising interest rates can reduce corporate profits, affecting stock prices. Diversification reduces risk, but does not eliminate it. Investors must accept that losses are part of the journey. Successful investors focus on risk management rather than eliminating risk entirely. Understanding historical market cycles helps investors stay calm during downturns. Why some countries strictly control the stock market. Governments regulate stock exchanges to maintain economic stability. In some cases, authorities temporarily halt trading during extreme volatility to prevent panic selling. Some countries impose restrictions to control capital flight, where investors move money abroad quickly during crises. Governments also aim to prevent market manipulation and insider trading. Strong regulation builds trust, but excessive control can discourage investment. In unstable economies, stock markets may reflect political risk. Leaders sometimes intervene to protect currency value or prevent economic collapse. Therefore, regulation is not always about fear. It is often about stability and national interest. The stock exchange is neither gambling nor magic. It is a powerful financial system that rewards knowledge, patience, and discipline. It allows companies to grow and investors to build wealth, but it also punishes emotional decisions and blind speculation. Understanding how it works, managing risks, and thinking long-term can transform it into a tool for financial freedom. The opportunity is real, but preparation determines success. As we come to the end of this journey, one thing should be absolutely clear. The stock exchange is not a casino, and it is not a shortcut to instant riches. It is a powerful financial engine that has built some of the greatest companies in the world and created long-term wealth for disciplined investors. But like any powerful tool, it can either build your future or damage your finances, depending on how you use it. We have understood what the stock exchange is, how it works behind the scenes, how money is earned through capital gains and dividends, and the smart principles that increase your chances of success. We have also seen the risks, market crashes, emotional decisions, economic instability, and why some countries strictly regulate or control their markets to protect their financial systems. The truth is simple. The market rewards patience, knowledge, and emotional control. It punishes greed, fear, and blind speculation. The biggest mistake beginners make is entering the market without preparation. They follow trends, listen to rumors, and chase fast profits. But experienced investors think differently. They study companies, they diversify. They stay calm during market downturns. They understand that wealth is built slowly, consistently, and intelligently. The stock exchange reflects human behavior as much as economic performance. Prices move not only because of numbers, but because of confidence, expectations, and global events. That is why education is your strongest investment. Before you invest money, invest time in learning. The opportunity is real. The risks are real. The choice is yours. If you approach the stock market with discipline, strategy, and a long-term mindset, it can become one of the most powerful tools for financial growth. But if you treat it like a gamble, it will eventually teach you expensive lessons. Your financial future will not change overnight, but with knowledge and consistency, it can change permanently.
Friends, this video was prepared for education and truly correcting information and knowledge. If you like this video, please follow and subscribe for our favorite comments.